afternoon, everyone. Welcome to the Stock Market Morning Prep video for Monday, June 30th. Well, we do have a holiday week upon us. We have the July 4th holiday on Friday, and therefore Thursday will be also a half a day. So just wanted to get that out to you guys, just in case if you did not know that we had a half a day on Thursday. So what does that happen is that it pushes all of the economic data that is coming out this week, especially, as you all know, the non-farm payrolls that come out the first Friday of every month. That will be announced on Thursday. And even though we have a half a day, that still will be announced on Thursday. And that's a big number, guys. We all know that. Along with that is going to come out with the June ISM non-manufacturing report. And then on Thursday, even more, we have the ECB policy decision and, of course, press conference. That is always another big market mover. So Thursday is going to be the biggest event day there is. So if you are long a great deal of stocks, you might want to hedge or trail up your stops accordingly to your trading plan. Now, we do have a couple of things coming out. Tomorrow is the July 1st will come out the ISM June manufacturing and auto sales figures. So watch out for the autos on Tuesday, and Wednesday we have the June ADP employment change, which is kind of volatile number, if you will. So that's really not to be reckoned with, but you want to just kind of keep an eye on what it says. It kind of forecasts supposedly what the non-farm payroll numbers come out, but I tend to put a little grain of salt with that. But nonetheless, we have a lot of economic news, shortened week, no volatility whatsoever. We had one down day on Tuesday. Markets kind of recovered. Did close down small on the week, but again, there is absolutely no volatility. The market continues to be well bid up and just grinding higher. So it's going to take a big event risk to happen for this market to roll over. Now, does not mean that at any given moment the markets could just sell off, and that has happened many, many times. So you need to be aware, and you need to be ready and willing to be looking to short stocks if indeed the market does decide to sell off. Do we short stocks here or pick a top? Absolutely not. What I'm looking for, again, is stocks that have sold off already and have now been in their basing pattern formation. And once the price starts to break out of that base is what I'm looking for. Yes, is it counter trend? Of course. But I'd rather buy stocks that are maybe down to slightly up on the year versus just saying, not that I trade it, like a Netflix that just rallied 100 points in 30 days. So it's just lunacy out there. People are continually buying stocks and chasing stocks that are, up 20, 30, 40%. And all it takes is 2 or 3 down days and the stock's back to where it was. So don't put yourself in that type of predicament. Just look for good quality stocks. And if you're day trading, it is a stock picker's market, which means that there's less trades to be had because you can't look at 7,000 to 8,000 stocks in a day. So you need to just be aware, pick your good quality watch list and work that watch list stocks that you know. And if there's nothing happening for you on that day, then move on to the next. All right, so let's go right into the indicators. There's a few that I like to look at, and again, when you have stocks that are just grinding like this, the indicators really don't do too much. But I will say that there are a few that does tell me that hey, use a little caution. We have the bullish percent SPX, and you can see here every time the bullish percent crosses that 8, we always get that either sell off or that pullback. You can see here it works really nicely. Yes, there are some whipsaws. So in this type of environment, we did have a little bit of a crossover giving us a sell signal in the S&P, but I'd like to see it a little bit more start to separate. Sometimes you get that little whipsaw that we come back up and then we challenge this area and then we sell off. So we are, I think, at a point where the markets are now starting to get a little tired, and they are, I think, ready, if not now, but we also need a trade. We also need a signal too. So just when I say ready, I don't mean that we're ready to short the market, but they're getting tired, and you can see that the market's been tired from here. We had literally a 30-day run of just straight up grind, low volume, no conviction, move higher. So that's something you have to really be careful with. Here's something that I like to look at also is the advanced decline. Now, as you can see here, markets are moving up. The advanced decline breadth is not. Now, it can easily start to break out. But here's really the breakout, Ken. If we take out this area here, this 600 in the advanced decline, then I think, believe it or not, I think that the S&P could challenge the 2000, 1180, 2000. I'm sorry, 1980, 2000 area easily. So this is something that we're going to be watching. I'm going to start putting this back on my radar again. I usually look at the indicators, twice a week when there's nothing going on. But this is something that I'm going to be keeping an eye on. Also, is the New York Stock Exchange new highs. We're not making new highs here. Okay, and if you look at the Nasdaq, which I don't have here because it's a short video, it's doing the same thing. So this is a little nerve-wracking for me. And any bull, if you're a bull, why isn't the New York Stock Exchange stocks making new highs if the markets are making new 52-week highs? And that's interesting. So we need to really watch this closely. And lastly is the VIX. Everybody says the VIX is not the indicator it was anymore. Nobody cares. Well, if the market does sell off, it's going to start to spike up, and that's the reason what's happening. The market has not sold off, so the VIX just continually breaking down, making lower lows and lower highs. But look what's happening. Your Bollinger Bands are starting to pinch. MACDs are starting to cross over to the upside. We did get a crossover earlier in the week on the stochastics, the 14.3. So all this takes is one little push lower, and this VIX will start to spike again. So it's not doing much pretty much most of May, June, and now going into July, but that's because the markets have been rallying. So I do think this is still a viable indicator. It's a good fear factor index and a good measure of risk, and this is telling us that obviously there's no fear in the marketplace. So just a word of caution, when you see something like this, if you're day trading, it's meaningless for you at the moment, but you definitely still want to know what's going on in the broader picture, even if you are day trading. So here's another couple of things that I look at is, now the spot yen is inverse to what the S&P is doing. So if the yen's higher, S&P is lower. If you're looking at the dollar yen, they're correlated with S&P. It moves with along S&P. Okay. So now we have strength, now renowned strength in this spot yen, and with the index is still making new highs, it's just very odd to see that the yen is now moving higher. Okay. Also, we do have this 200-day moving average, which I think would cap any rally in the short term. But if it does break out, you have to be very careful here, okay, with equities. Now, look at bonds. Bonds is very interesting. Now, I've always said, back up, I believe, right around here, and we identified an inverse head and shoulders pattern, which is here, left shoulder, head, right shoulder. Neckline was right up in this area here, broke out, and then we have our neckline target coincides nicely with the 1618 of 140.26. So I do think it still gets there. You can just see that the bonds are well bid up. In the longer term picture now, I do think bonds move a little lower, but I think bonds are in a short squeeze. I think that bonds will have to cover more, and I think that you're going to see this ultimate target hit at one point in time. We already hit that 1.272, and I think we break out of there for the next shot. We tried it twice, we failed. I think the third time's a charm, and I think it breaks. And if that happens, money will flow into bonds and will move lower in equities. And we haven't had a sell-off in I don't know how long. And I don't mean a one-day sell-off. I mean a significant sell-off, and even a 5% sell-off we haven't had in months, many months. So I think that we're due for a summer sell-off. We were due for a sell-off months ago, if that's even the term. But I do think that we're looking for, especially when you have the summer months with low volatility, the moves are exaggerated. So whether it be up to the upside or downside. So again, just use the word of caution here. There's a lot of things that are not, that doesn't seem right, and doesn't mean you can't trade. It just means just be careful. ES still at the 1618, holding up well. We had a sideways, pretty much one down day, recouped, and now we're down here. Did make new intraday highs of 1960, so that's going to be the new upside target. And then, of course, the next extension really is going to be the 2000. Well, that's the 2040 on the daily. We have some closer fib targets, which I'll show you once we do break out that little cluster, if we do. Now, diamonds here, one of the weakest, but again, still holding the 1272 extension. Needs to break back out of that, and then we'll see what happens. But we are holding true to the upper end of the range here, so nothing wrong with that. Again, the markets in general look okay. It's just very extended, and without a meaningful sell-off, you just have to wonder, when is that going to happen? So not that you can't participate to the long side, just got to use caution here, that's all. Transports very, very slow. Slow week. Really didn't do much of anything. But again, bullish symmetry is still upon us, and we're still holding it upper end of that range. And I think you still see this test of its lows, if not lower. That'll be the 50-day moving average. I think you see the 50, and then eventually still break down. And I think that canary in the coal mine is going to be crude oil at one point. And IWM looks like another bull flag happening here, so another good test. I think it challenges the highs, as you can see right up in this area here. So watch out for higher prices in the IWM. And lastly is going to be the Qs. Now, big cap tech, Netflix, Google, LinkedIn, all of those guys are doing Tesla. They're all doing very, very well, and it's moving the Qs, obviously, big cap tech. But they're extended. They're very extended. So if you do trade them, use caution. I mean, they're very, very extended, and that's why the Qs are doing well. Taking out the 1272 extension on the close on Friday. Next step is going to be the 1618. All right, guys, I hope it helps. Again, we're very extended here. A lot of warning signs. Obviously, the markets have ignored the warning signs. The negative GDP print, which is insane. But we'll see what happens. We'll see what happens on Thursday with the non-farm payroll numbers that are coming out. Have a great day. We'll speak to you tomorrow. Take care.